Top of the morning to you, all you Wealth Press subscribers and readers and visitors. Today we're here at the Friday morning market wrap-up with Roger Scott as usual. Roger, how are you doing today?
I'm doing really good. How are you, James? And again, thank you for having me here.
Yeah, you bet. I'm well as well, thank you. So Roger, the markets are drifting higher, which is interesting to say. In August, drifting higher is an odd phenomenon, but it seems like the sort of inertia and momentum of all of that capital, all of the quantitative easing now making it's percolating into the system, and profits are being made, and that money is compounding. And I guess, how can asset prices do anything but go up is my opening question for you today.
James, it's very, very hard to I was looking at the numbers this morning. I was looking at the unemployment report. I was looking at everything that would give me some indication. And quite honestly, I just don't see it. Unemployment rate is going up. We have only 42% of the workforce going back to work at this time. And quite honestly, I don't see a situation that is going to give us a catalyst up, especially with all the unknowns going on right now, with the economy, with the election coming up, with earnings completely being out of whack. It's definitely causing me to reevaluate individual stock positions and focus a lot more on the broader market and on defensive tactics, on bonds and on the gold market. Now, I don't know if this is going to be it. And we've had these situations countless times where it's just a momentum-driven market. So it's hard to say till we see other signs. And right now, we're just not seeing those signs yet. And the question is, when are they going to come to light? When are we going to be seeing them?
Yeah, that's right. There was Catherine Mann, who is the one of the heads of Citigroup Economics, was suggesting that the U.S. dollar's sort of primacy as the reserve currency of the world was intact, and that the rise in the price of gold was less to do with the U.S. dollar strength than it was to do with the other micro factors. And I found it interesting that that position could be defended by an economist at a group like Citi, but then I of course understand that the supremacy of the U.S. dollar as a reserve currency is maintained by U.S. dollar swap lines.
Right.
And so that's where the U.S. dollar says, well, tell you what, we'll give you X volume of U.S. dollars in a, pretty much a pure swap for your currency as a way to keep you buying things in U.S. dollars, which is, okay, I don't know if that qualifies it as a reserve currency, but anyways, this is, I think, one of the factors that underlies the strength of the U.S. dollar that is not broadly well understood, and which is really one of the fundamental platforms from which stock prices in the U.S. continue to rise, because these U.S. dollars are being supplied to economists and banks around the world and funds around the world, and that gives a real incentive to buy U.S. dollar denominated assets.
Right.
And especially ones that are continuously going up. So that's why I look at the jobs numbers today, better than expected. Okay. I look at some of the earnings along lines with expectations that, of course, we're going to see diminished earnings alongside diminished economic activity, but the market still trends higher. NASDAQ set a record on Wednesday, almost set a record yesterday. Now it's drifting a little lower. The S&P is 45 points away from its February all-time high.
But when you look at internals, right now, if you look at the internals, if you look at stocks trading above $2 a share, only 42 or 43% of them are trading above the 200-day moving average. The stock market is extremely lopsided. As a matter of fact, it is so lopsided, it's never been this lopsided before. Usually, and again, because usually you have a financial downturn, which takes everything down. Here, you have it's like that game, the whack the mole. You hit one, the other one pops up. You hit the other one, another one pops up. the capital is still going in somewhere. That's the thing. So you're, instead of seeing it go into 9 out of 10 companies, you're seeing it going into 2 out of 10 companies or 1 out of 10 companies. So it's a very, very difficult way. And because US markets are capitalized weighted, that adds another wrinkle to the mix. So you're literally having a very lopsided market, a market that's really, it's, you know what it's like? It's like looking, it's like gauging how America is doing by only looking at people who are making over $500,000 a year. You know,
Right.
if you look at that, then obviously things are going to be looking. So it's you see the way the indexes are represented is specifically designed to let the leader express or represent more of that control, and that's causing people, oh, I'm looking at the S&P, oh, it's making all-time highs. Yeah, but let's look deeper. Let's look, there's a lot of cracks in that foundation. And look, I'm a bullish guy. I'd love for there to be a bullish market for eternity, but we got so many things distorting the big picture right now. 2.2 trillion, more money coming in. Where exactly is that money going to be going? Which sectors are going to be moving into? Does that sector have the market capitalization that's necessary? You see, there's a lot of factors here. So ultimately, if we step back, if we really step back, and I know you like to step back really, really wide, which is fine, there's a lot of cracks in that foundation. But when you start looking closer and you start looking at individual companies and you start looking at the way money flows is going, the fact that pension funds have to allocate money on a weekly basis, and those pension funds are just accumulating and accumulating and accumulating on a continuous basis, it's almost like the stock market has taken on a very different kind of a life of its own. You know, last time we spoke, we were here with Adam, and we were here with I believe it was who else was
Jeff? Yes.
Thank you. And we were talking about Warren Buffett, and we were kind of talking about whether Warren Buffett has lost his touch, so to speak. And I don't know if that's, but we were talking about it, and I was thinking quite about that conversation afterwards, and it's been kind of all week I was thinking about it. I was thinking, has Buffett lost it? Because he sold the airlines at a really he got out of airline stocks literally like at the worst time. And again, I'm not criticizing Buffett. He's done better than all of us put together. But again, there's certain factors. He's still holding on to these nasty bank stocks, and to me, they seem like they're going to be just going lower and lower. Wells Fargo, he has a major. So I'm thinking to myself, and I'm thinking, is it possible that traditional Benjamin Graham investing 101 has completely lost its way? And I don't think we're there yet, but I think we're getting close, especially with all these Robinhood traders bringing momentum into the market. And also, you got to also think about this. We've got enough volatility right now in the market. Let's step back and look at it from a different perspective. You've got enough volatility. You've got enough price cap in the market where swing traders, day traders, swing traders, people who had no potential to make money 10, 15, 20 years ago, there's enough swing in Amazon. I'm willing to bet you there's an Amazon day trading group, and they're just going, they're funneling volume into that stock day in and day out. So there's so many different segments of traders right now doing so many different things. It's very, very hard to be a Warren Buffett, Benjamin Graham style of investor right now. So I haven't traded that way since 2004, 2003. And I'm going to tell you another thing. Honestly, if you look at Warren Buffett's returns over the last 15, 20 years, they haven't been that stellar. He peaked out around the early 2000s. He hasn't been getting us that 22% per year. Actually, I'm going to tell you something very interesting. There is a website, an organization called it's American. I'll get you the name, but it's an organization that collects different strategies over 30 years, fundamental strategies. In other words, earning strategies, Warren Buffett strategies, William O'Neill strategies. And they show you how those strategies have done over time. And I'll get you that after we're done with this. You can maybe add it to this video or whatnot. But and honestly, Warren Buffett's not even in the top 20. I'll tell you what's been working amazingly well, consistently, what has overranked Warren Buffett, and this didn't just happen this year or last year. The strategies that has overperformed every market strategy has been earnings revisions. In other words, expectation. In other words, sentiment. The number one strategy, not 20 years ago, but over the last 20 years, now and last year, sentiment. Traders are turning to sentiment, not value, sentiment. It's almost like the stock market has become an options market, a derivatives market.
Sure.
You know, it's kind of taken on. So I think, and look, James, technology advancements, different groups, it's bound to happen, you know?
Right. Interestingly, James Dines, who is arguably credited as one of the founding fathers of the financial publishing industry, he wrote the book Mass Psychology, which essentially argued that if you understood where sentiment was going and you got in front of that through your market activity, that you could consistently win. And it's interesting that that book was, I think, published in 1970 something. And it's interesting to me that to this day, or rather resurgent today, based on what you're telling me, is that sentiment maybe has always been the secret to winning in markets, to the point where we know for a fact that successive presidents in the United States are targeting sentiment by creating the opportunity for market indices to demonstrate viability, vitality, and growth, which creates a fear of missing out, the FOMO, which is probably the sentiment that is one of the easiest things to see in the marketplace when the mania kicks in on a stock, when it suddenly goes up against all rationale. Tesla's the best example. And it just takes on a life of its own, as you say. And interesting in the concept of the market having a life of its own, to the extent that central banks create tier one capital on balance sheets, that is the foundation of fractional banking, giving subsequent banks that put tier one capital on their balance sheet the ability to lend out 8 to 10 times more value than that tier one capital holding. And now that goes out into the banking system and starts to compound. The banks lend it. The banks have proprietary trading, but also they are the primary suppliers of capital to funds, who are leveraged funds, who are now comfortable to take leverage up to the maximum because the market has demonstrated this constant appreciation. And so the market has really created a self-replicating fuel for itself, in that now these giant funds and capital positions are deploying capital on a massive scale, driving asset prices higher. They're taking profit off the table in short time durations, diverting some of that to other strategies like gold on the off chance that this music is going to stop. And so that's why I look at, yes, you're right, the number of stocks that are supporting this increasingly high number of floors in this skyscraper made of paper are fewer and fewer. And I guess that's your point, is that fundamentally is a tremendous growing risk against the integrity of the entirety of it. And so that's what we've kind of got to strategically plan for.
Right. Yes. Look, you know what it is? It's kind of like this. Imagine you have a little coffee table and you keep putting things on it and you keep putting things on it and you keep putting things on it, even things that you shouldn't put on it. It's not going to break right away, but eventually it's just going to get pressured and pressure. And eventually it's just, unless something is done, it's just going to pull back. But while it's working, while it's standing, while it's still functioning, nobody touches it. It's kind of like that, kind of like that. And just to add to your point, look at the between the Dow Jones and the NASDAQ. Okay. Why is the NASDAQ growing so much? Speculative sentiment, speculative sentiment. It's doing it to the NASDAQ. Why is the volatility so great in the NASDAQ? Speculation is driving the market. But before, value would overrule. 30, 40, 50 years ago, value would overrule sentiment. Now, it's just sentiment and nobody's even thinking about value. Value is an afterthought. I mean, is Tesla ever going to be profitable? How much money is Amazon actually earning net? You see what I mean? That's not a question anymore. It's a question of how big are they going to get? Are they expected to be bigger? It's always, let's look into the future and see what else we can expect. And as long as we can continue looking into the future, we don't need to look at the past. The only time we're going to need to start looking back is when there's nothing in front of us. And as long as the Fed keeps pushing money into the market, as long as President Trump keeps talking about the greatest stock market in history, as long as companies start giving forward-looking statements, that's the game we're in right now.
So then I guess it would behoove us as investors to learn, rather than try to predict when the music is going to stop in the musical chairs game and where we're going to have to find a seat. We need to learn to condition ourselves to identify the symptoms of the music getting ready to stop. And
yes.
And I think that your point about there's a fewer number of stocks supporting the astronomical valuation incline, that's certainly one symptom. But what other ones might we look for is my first part of my question. And this is going to be a long answer, I have no doubt. But what symptoms should we be looking for? And how do we rebalance our portfolios so that when the tsunami hits, when the music stops, how do we guarantee ourselves a chair?
Well, there's several ways. First of all, traders have to start looking at internals. A lot of traders are just looking at these charts and they wake up every morning, they turn on their CNBC. Oh, the Dow Jones is bad. That's just part of the story. You got to look at internals. You got to look at volatility. Internals of volatility are telling us completely different things. Volatility is 2.5 times higher right now than it's been in the last 5 years. Yes, VIX right now is still above 20. VIX has been.
Wouldn't that sideline a whole bunch of funds that have a low sort of risk tolerance in their models?
Yes, it would, and it would cause them to reduce their exposure substantially, or increase their level of hedge. Absolutely, no question. No question about that. That's number one. Number two, besides looking at the volatility and besides looking at market internals, the best thing to do, and I always tell traders to do this, always have a hedge in your portfolio. You never know when these things are going to happen. For example, during the little February fiasco we had, one of our systems had an energy hedge. The hedge made over 600%. The 2-week hold was 69 something percent on that account. And that was a US stock account. So instead of losing 25 or 30%, traders made almost 70%. Another cluster system we have, we always hold a bond, a triple leveraged bond. And James, you don't know how many emails I get from people saying, why do I need this? What do I need this for? It's always losing me money. Yeah, well, it made over 440% during that 2-week period. Anytime the S&P hits the 200-day moving average, flight to quality. So always having a hedge, because here's the thing, the markets, when they fall, mm-hmm. And they do very, very fast. So you don't need to have a lot. See, a lot of traders believe, I'm going to lose my long exposure by 50% or so. No, not at all. Not the way we do it, at least. We are able to have our cake and eat it too. And I'm not trying to, pat myself on the back. I'm telling you actually what we did. And I would say February was a pretty characteristic month of a bloodbath. Our strategies, our clustered strategies made money. They made a lot of money on the way down and on the way up. They thrive in volatility. So the key is for traders to keep your eye on internals, keep your eye on gold and bond prices, keep your eye on volatility, and keep your eye, most importantly, keep your eye on these levels, on these momentum levels, and which stocks are rising and which stocks are falling. There's actually tons of signs, and we see them all the time. There's divergence, there's the RSI. But the problem is, James, most of the time when we see a correction, they tell you there's something's going to happen, but they don't tell you how steep it's going to be, and they don't tell you how long it's going to be. So it's a big question mark of, is this going to be the big one or not? So I treat them all exactly the same way. I treat them all like it's going to be the big one. Every one of if you look at the Titan or the Precision Profit portfolio, they have, Alpha Rotation, they have a hedge. And that's what I always tell traders: trade like a hedge fund. We don't know when it's going to happen. But if you always have a hedge, if you always have a little bit of exposure, it can literally be the difference of having a double digit loss and a triple digit gain.
Sure. Can you give me some examples of some of the triple leveraged ETFs or bonds that you would sort of seek to include in such a strategy?
Of course, I'd love to. One is the TMF. Okay. And another one is the gold one. It's NUG and it's NUG something. I don't remember the exact ticker, but it's NUG.
NUGT. I know it well.
Yeah, NUG, and also the SSO for the SPY.
Okay.
That's a leveraged ETF as well.
So interesting. Gold keeps coming up in our conversation, Roger, and I know that you're increasing your exposure to gold, as am I. And gold has a real history of skepticism. When financial publishers begin to talk about gold, there's a high level of suspicion on the part of the general public that somehow we're going to benefit by talking about gold. And I know certainly in my case, my only real major gold position is in a junior that I bought last year that, the deal that's in it, that's driving its value, was not even a thought last year when I bought it. So it was just really luck that I bought a big piece of a shell, and it turned into somebody put a great gold deal in it. So in that sense, yes, I benefit. But of course, to my subscribers, every time I mention the company's name, I disclose the fact that I bought this number of shares at this price. And yes, I'm owning it cheaper than you, but I still own every share. So that should tell you something. I think it's going higher. But gold itself, there's no way for us to benefit from a general move in the gold price except by owning physical gold, which at this point, apart from a ring and some electronics, I don't actually own any physical gold at this point, having sold the last holding I had in physical gold to complete the purchase of my property for cash without having to take on any debt. So gold served its function perfectly in a time when the purchasing power of currencies was declining. I had purchased gold and the gold price appreciated. And so the value was not just preserved, but it was accelerated and amplified. And I think that's the key message about gold that people fail to really understand, and that we are in a great position to convey. It's like, you're not buying gold to try to flip it in 3 months for a 22% gain. You're buying gold to preserve the purchasing power of things like your home and the money and the equity you have in your life.
Right. Because ultimately, if the US dollar fails, what else do you have? I mean, or if it goes down like it's been going down, what else do you have? No, I couldn't agree with you more. And I've never been very big on specific gold companies. That's just not my cup of tea. I've always been exposed and always had exposure to just the GLD ETF, which tracks gold, or the spot gold if I'm trading the futures contract. So yeah, I don't have, as a matter of fact, I don't have exposure in any gold company. So I have no bias towards it at all. Yeah, I'm seeing a big trend in gold. I'm seeing a long-term trend in gold. I think this is going to be the 6th biggest rally in gold that we've had in the last 50 years. We've had 5. I think this is going to be a 6th one. Once you get past a certain breakout level, which we're at right now, and Jeff was telling you, you and Jeff were talking about, Jeff's in an area when we had him on a few weeks ago, he was saying, I'll buy it only if it breaks above a certain level. We are above that level now. And if we could, there's a strong chance about statistically about 66 to 70% chance, statistically speaking, that gold will continue moving higher from this level. And again, every time, as I mentioned before, every time gold moves higher, silver lags behind but finishes the rally ahead. So if you guys are, if you're thinking there's going to be a really strong gold move, and I do believe silver can have the potential to gain 10 times on that because the leverage is so different.
Right.
So
Right.
I'm expecting that as well.
So September 6, 2011, gold touched an intraday high of $1,924, its previous record. And on that day, gold was trading at $46 an ounce. So today, here we have gold back well beyond that record at $2,050 as we speak, and yet silver is at $28. So is that sort of the opportunity you're referring to in the immediate term?
That's exactly the opportunity that I'm referring to in the immediate term, because silver still looks like it's kind of lagging, like it could be going up, and gold looks like it's already there. Don't underestimate that. Silver, every time this happens, every time there's a major rally, it's happened 5 times in the last 50 years, and every time it's happened, silver followed gold, but silver lagged behind in the beginning, but finished higher. It's happened 5 times. All you have to do is look at it. I mean, it didn't happen 30 times. It only happened 5 times over 50 years. You could look at the trend every time. You'll see gold starts up when gold gets really hot, silver starts heating up, and the silver moves, it goes faster and quicker, and it catches up, and it on a relative strength basis, it supersedes. It's happened every single time. And if you look at the high on silver right now and look at where silver is, you could see physically on the chart, it's got a lot more to go. It's got a lot of upside to go.
Yeah. Yeah.
So
okay.
I'm bullish on silver. I'm more bullish on silver in the long term, actually, than gold as a result.
Yeah, me too for right now. Exactly. Okay, Roger, why don't we leave it there for now? It's been a pleasant conversation and very, very informative and inspirational as well as usual. I really enjoy our Friday conversations.
Me as well.
And I look forward to speaking to you at Monday's Roundtable. I hope you have a fantastic weekend.